Good afternoon, and welcome to Bulls, Bears, and the Bell. This is where we take the latest market action, look at the source materials, and really dive deep to pull out those crucial insights you need.
And we are definitely diving deep today. We're looking at what was, frankly, a seismic week for global markets. It all culminated on Friday, September 19th, 2025.
Yeah, the sources you shared, they paint this picture of just sheer market exuberance, conviction even. It feels like something fundamentally shifted in the investing landscape.
That's it, exactly.
So that's our mission today, right? To go beyond the headlines, unpack the two big catalysts they seem interlocked that sent the S&P 500 and, well, everything else to these dizzying new records.
And then we need to dissect that huge thematic shift underneath it all. Analysts everywhere calling it the return of animal spirits.
Animal spirits, investor confidence, maybe bordering on euphoria.
That's the term, yeah.
Yeah.
Let's start with the hook, the big picture number that really shows why this week mattered so much. U.S. equity markets just wrapped up their third straight record-setting week.
3 weeks in a row.
The momentum was just staggering. Estimates are around $15 trillion added in total market value.
15 trillion. Wow.
I mean, put that into perspective for you. That amount, that $15 trillion, it's bigger than the entire annual GDP of major economies like, say, Japan or Germany.
Okay, so this isn't just some minor rally.
No, this isn't a flash in the pan. This is a comprehensive, multi-trillion-dollar injection of systemic optimism. You don't get that kind of move without something huge happening.
$15 trillion, exactly. That kind of capital flow needs extraordinary drivers. So to really get a handle on the confidence behind that torrent of money, we have to look at the twin engines, as you said, that powered this surge.
Right.
Let's start with the main one, the policy action that basically reset the whole macro environment, the Federal Reserve.
Yeah, the primary engine, no question, was the Fed's definitive pivot. That really played out on Wednesday. The FOMC, that's the Federal Open Market Committee, the policy-setting group, they voted to cut the benchmark interest rate.
The big one.
By 25 basis points, yeah, 0.25%. So the new target range is now 4.00% to 4.25%.
And this was huge, right? Not just a little tweak. It marks the formal start of a new easing cycle.
Absolutely. It's the first rate cut of 2025. It ended that 9-month pause where they were just holding steady.
Yeah, and the market reaction was instant. They saw this as the Fed kind of giving up its defensive stance against inflation, didn't they?
Well, yeah, the reaction was seismic. But the justification from Chairman Powell, that's what really needs attention. He didn't frame this cut as, oh, the economy's booming, we can handle it.
No.
No, he explicitly called it a preemptive risk management move. And that's really crucial central bank language.
Risk management. Meaning what exactly?
It means they're moving before the data gets really bad. They're trying to engineer a softer landing for the economy rather than reacting after things have already started falling apart.
Okay, so being proactive. And the official reason they gave for this preemptive strike, it was in the FOMC statement, wasn't it?
Yes, and it was a very explicit acknowledgement of a visibly slowing labor market.
That phrasing, visibly slowing, that feels like a big change from how they've been talking about the job market for ages. They always called it resilient.
Exactly. It's a drastic departure. And the specific data point they leaned on gives us a clue about their fear threshold. Unemployment ticked up to 4.3% in August.
Which is the highest it's been in
nearly 4 years. And historically, central bank studies show that once unemployment starts rising consistently like this, especially when it gets a certain amount above its recent low, a full-blown recession often isn't far behind.
So by moving at 4.3%, they're saying this is as high as we're comfortable letting it go.
They're signaling a very low tolerance for any more labor market weakness, yeah. They're trying to nip that employment decline in the bud before it really takes hold.
Which brings us right to the policy dilemma. This is why the cut feels so unusual, but also why it's so powerful for the markets. They cut rates even though inflation is still, well, sticky.
Still somewhat elevated, as they put it, and definitely above their 2% target. They're worried about jobs and inflation at the same time.
That's the balancing act.
Correct. Powell even admitted the unusual nature of the current situation. By cutting rates, when inflation is still a worry, the message to investors is pretty clear.
Which is?
The Fed has implicitly signaled it's now prioritizing its maximum employment mandate over the price stability one. The market thinks it's found the Fed's pain point job losses and believes the Fed will fight that aggressively.
Even if it means letting inflation run a bit hotter for longer?
That seems to be the interpretation, yes.
And for risk assets, for stocks, what does that signal ultimately do? It almost sounds like an insurance policy.
It feeds right into that perception of the Fed put.
Yeah,
The idea that the central bank will step in and prop up markets or asset prices if things get too rocky.
right.
When the Fed signals it won't tolerate much job market weakness, they're effectively putting a floor under the economy, or at least
Yeah.
that's the perception. That lowers the perceived downside risk for investors.
Making them more willing to buy riskier things.
Exactly. It makes them much more willing to take on exposure in stocks, especially those growth stocks whose valuations really depend on cheap money being available down the line. That shift in risk perception, that's the psychological bedrock for those animal spirits coming back.
So they're not just reacting to data, they're actively trying to boost market confidence. And that confidence, it's already looking past just this one cut, isn't it?
Oh, absolutely. You look at the new dot plot, that chart showing where each FOMC member thinks rates will be in the future, it was very encouraging if you're bullish.
What did it show?
The median FOMC member now expects one or maybe two additional 25 basis point cuts by the end of this year, 2025,
Okay.
which would take the target range down to maybe 3.50% to 3.75%. And importantly, the projections clearly signal that easing will continue into 2026.
So this is the start of a trend, not just a one-off
Yeah,
adjustment.
it's how the market read it, yes.
Now, I do want to touch on the internal debate because the sources mentioned a significant dissent. It wasn't unanimous.
No, it wasn't. Governor Stephen Barron, who's a relatively recent appointee, actually dissented. And crucially, he voted for a more aggressive 50 basis point cut.
50 points.
Yeah.
Wow.
Which signals there's very real pressure both inside the Fed and probably from outside too, pushing them to ease policy even faster to get growth going.
So the argument inside the Fed isn't if they should cut, but how fast they should cut.
That seems to be the case. And that disagreement itself is actually a dovish sign for the market.
Okay, so if cheaper money was engine number one, providing the fuel, the second engine was this unexpected geopolitical tailwind. It seemed to hit Friday morning and just gave that extra confidence boost needed to really break into record territory.
Yeah, the timing on that was, well, pretty perfect for the market bulls. Strategically, couldn't have been better.
It was the news about a phone call, right, between U.S. President Trump and Chinese President Xi Jinping.
A constructive and apparently lengthy phone call. After months of things just sort of simmering, trade tensions, political friction, this just provided instant relief. It felt like it unlocked global capital.
Because the tone seemed genuinely positive, forward-looking.
Exactly. When the market perceives that trade wars are de-escalating, it removes this huge headwind for multinational companies, for global growth in general.
President Trump apparently called it very productive on social media, and they reported progress on a few fronts.
Yeah, managing trade imbalances, trying to control the flow of fentanyl, and then the big one, especially for the tech sector, the approval of the TikTok deal.
Ah, the TikTok saga. That's been hanging over things for ages.
For years. If that deal gets formalized, it removes this massive layer of regulatory and ownership uncertainty that's plagued the tech and communication services sectors.
Right. If big digital platforms can operate with some clarity between the U.S. and China, that's a major plus for valuations. Lets companies actually plan long-term again.
Absolutely. And reinforcing that commitment to de-escalation, they also planned actual meetings.
Face-to-face.
Yeah, the leaders committed to meet in person at the upcoming APEC summit in South Korea. And then President Trump committed to visit China in early 2026.
So, real diplomatic engagement planned. That signals a mutual desire at the top level to keep communication open, stop things from sliding back into those tariff wars we saw before.
So you put it together, and you have this dual support system firing on all cylinders.
Okay.
The market rally is now basically built on the idea that both these trends continue. The Fed keeps easing, meaning cheap money keeps flowing, and U.S.-China relations stay constructive, meaning better trade and less corporate uncertainty.
When those two pillars line up.
You get systemic risk coming down.
And when you slash systemic risk and inject cheap money at the same time, apparently you get $15 trillion added to market value in about a week.
Seems about right.
Okay, now let's look at what that actually meant for the benchmarks, the index numbers, and maybe more importantly, what it tells us about the internal health of this rally.
Okay, let's quickly run through the final closing numbers just for context. When the bell finally rang on Friday, September 19th, all the major indices had posted pretty solid gains, cementing that strong weekly performance.
Give us the numbers.
The S&P 500 was up 0.41% on the day, closing at a new record, 6,658.69. That was its 26th all-time high just this year.
26th.
The Dow Jones Industrial Average, it gained 0.37%, finishing up near 46,311. And the tech-heavy NASDAQ composite, it actually led the pack on Friday, advancing 0.63% to close at 22,572.06.
That's impressive consistency across the board. But those are just the headline numbers, right? We need to look under the hood a bit. The market internals, those underlying measures of buying conviction, were they confirming this move? Was it broad-based?
Yeah, they were flashing green, showing conviction. Trading volume was exceptionally strong, especially on Thursday, which was the first full trading day after the Fed announcement.
People were putting money to work.
Big time. Volume hit 19.30 billion shares. That's way higher than the recent 20-session average, which was around 16.7 billion. High volume on days when the market goes up, that's usually a signal that the conviction is broad, not just some thin air rally.
Okay. And the VIX, the fear gauge. Was anyone worried?
Seems like nobody was worried. The CBOE volatility index, the VIX, it stayed really subdued, trading around 15.70.
Yeah, very low.
For context, the VIX often spikes above 20, sometimes even 30, when real fear hits the market.
Yep.
A reading down in the mid-teens like that, it just reflects a distinct lack of investor anxiety.
Complacency, maybe?
Or confidence.
Yeah.
They're not scrambling to buy protection like put options. They seem to be aggressively betting that the gains will continue. That low VIX reading, that's another powerful sign of those animal spirits we were talking about.
Yeah.
Hashtag tag B. The crucial Russell 2000 breakout.
Okay, now, if you're looking for maybe the single most important signal that this rally might have legs, that it's structurally healthier than maybe some of the surges we saw earlier, you have to look beyond the S&P 500, right? You have to look at the Russell 2000.
Oh, yes. The small caps.
In my view, the Russell 2000 breakout this week, that was the key signal.
I'd agree with that. It provides really crucial context. It validates the whole narrative about the Fed's impact.
So Russell 2000, that's the index tracking small cap stocks, right? Companies that are generally more sensitive to what's happening in the domestic U.S. economy.
Correct.
And it did something huge this week. It broke past its previous record high, a high that was set way back in 2021, nearly 4 years ago.
Which is a long time to wait for a new high.
Exactly. Why does that matter so much? Because for most of the last, 18 months or so, this whole rally has felt incredibly narrow. It's been driven almost entirely by those Magnificent Seven mega-cap tech stocks.
That narrowness has been the big knock against this bull market. The main criticism. I mean, you look at the numbers over the last month. The Mag 7. Collectively, they gained something like 10.5%.
Huge.
While the S&P 500 equal weight index, which strips out the market cap weighting and just shows how the average stock is doing, that was up only 0.7%.
0.7% versus 10.5%. That's a massive divergence.
It's the textbook definition of an unhealthy, narrow market, where all the performance is concentrated in just a handful of massive companies.
So the Russell breakout, the theory goes, signals that the rally is finally broadening out. It's not just tech anymore.
That's the hope. That's the signal.
But is it really a broad rally yet? I mean, you mentioned the equal weight S&P is still lagging badly. Is this Russell breakout just a temporary thing driven purely because small caps love lower borrowing costs? Or is it the start of something real?
That's the right skeptical question to ask. And look, the narrowness challenge isn't completely solved. Remember, only about 55% of all the stocks in the S&P 500 are currently trading above their 50-day moving average. That's not exactly broad strength.
Still pretty concentrated then.
It is. But the Russell breakout is still a major step. It signals a potential leadership rotation. A potentially healthier market advance is forming because the Fed's policy pivot directly juices small caps.
Okay. Explain that connection more clearly for the listener. Why are small caps so much more sensitive to the Fed than, say, Apple or Microsoft?
Well, small cap companies, they tend to rely much more heavily on external financing, borrowing money to fund their operations, their growth, everything. They just don't have the massive internal cash hoards that the mega caps do.
Right. They need loans.
Exactly. So when the Fed cuts rates and signals more cuts are coming, it immediately and directly lowers their cost of capital. The interest they have to pay on their debt goes down.
Which improves their bottom line pretty quickly.
Massively improves their financial outlook, yeah. And that drives speculative investment into them because their immediate risk of defaulting or running into financial trouble gets lowered almost overnight.
So the Russell hitting a record high tells us investors, now armed with the prospect of cheaper money, are finally confident enough to jump back into these previously ignored, more economically sensitive parts of the market.
That's the interpretation. It's the very definition of increased risk appetite flowing beyond just the biggest names.
Okay, so the story is maybe, finally, moving beyond just the long-term secular growth of AI and starting to embrace a cyclical recovery, one that really needs low interest rates to get going.
That seems to be the narrative taking hold.
All right, let's look at where investors were actually putting that fresh capital this week. The sector dynamics should give us a pretty clean map of how the market interpreted this whole risk-on shift.
Yeah, the market's immediate reaction to the Fed's decision, especially on Thursday, was just a textbook risk-on move. That means investors favored the sectors that are most sensitive to accelerating economic growth and, crucially, lower borrowing costs.
Who were the clear winners?
The clear leaders were information technology, XLK, which jumped a substantial 1.7% on Thursday, and interestingly, industrials, XLI, which advanced 1.1%.
Okay, the IT strength, that's almost expected, right?
Yeah.
Given the ongoing AI excitement and the fact that IT makes up, what, almost 34% of the S&P 500's weight now, it almost automatically pulls the index higher.
It has a huge gravitational pull, yes.
Yeah.
But the really strong performance in industrials, that's a highly cyclical, capital-intensive sector that really screams cheaper money is here.
Yeah, industrials are the companies building the factories, moving the goods, buying the big expensive machinery.
Exactly. They need a huge amounts of capital for those big projects. Their outperformance confirms that investors took the Fed's move as a green light for economic expansion. They're betting that lower long-term borrowing costs will make these large-scale industrial projects more profitable.
So, given that strength in industrials, plus the record breakout and the Russell 2000 small caps, what does this suggest about where money might flow next? Are we genuinely looking at the start of a big shift, a rotation?
Well, we're certainly seeing all the early signs of what some strategists are now calling the Great Rotation.
Great rotation, okay.
The idea is that lower interest rates disproportionately benefit these capital-intensive cyclical industries, think industrials, materials, maybe financials, and especially those smaller firms in the Russell 2000. Many of these areas have been, frankly, deeply undervalued compared to the high-flying tech megacaps for a long time.
Because money was hiding in perceived safety and secular growth.
Precisely. The strength we're now seeing in these cyclical and small-cap areas suggests that capital might finally start migrating out of that highly concentrated, maybe somewhat defensive growth posture of the Magnificent Seven into the broader market, where valuations look more attractive on a relative basis and where profit margins stand to improve significantly simply because debt is getting cheaper. If this rotation gathers steam, it could really define the market trend for the next few quarters.
That's a really crucial insight for you, the listener. The big opportunity might be shifting, moving away from just concentrated growth and towards more diversified value and cyclical plays. But even with that broader bullish feeling, the moves in individual stocks this week showed just staggering divergence. You saw the real consequences of high-stakes volatility playing out.
Yeah, let's turn the spotlight onto some of those individual names. First, the top gainers, where you had these narratives of radical innovation, maybe some acquisition speculation, driving just massive double-digit returns on Friday alone. It really highlights how powerful those animal spirits can be when focused on a single stock.
Absolutely. This is where the market's enthusiasm gets hyper-focused and often highly volatile.
Kicking us off, we had Quantum Computing Inc., QUBT. It surged nearly 30%, 29.75% to be exact on Friday. And this wasn't just hype. It was backed by news of secured government contract.
Tangible validation, yeah. High-level institutional buyers stepping in. QUBT announced a subcontract with NASA's Langley Research Center. They're going to use QUBT's Dirac-3 quantum computer to help filter out solar noise, which is apparently a big problem for sensitive space imaging.
And, just as critically, they simultaneously announced an agreement with the National Institute of Standards and Technology, NIST. They're going to work together to develop next-gen photonic components, basically stuff needed for quantum networking.
So that positions QUBT as a key player in a field with big national security implications.
Exactly. Makes them look like a strategic domestic supplier. And the rally was definitely amplified because it's generally known the U.S. Air Force is dramatically ramping up its investment in quantum research overall.
Okay, so you've got cutting-edge tech, government backing. Sounds like the perfect bullish setup. But for an informed investor looking at this, there must be a huge flashing warning sign somewhere, right? The valuation, maybe?
Oh, absolutely. The caveat here is massive, paramount even. While the news is undeniably strong, the valuation is, well, it's astronomical, which is pretty typical when you get this kind of speculative fever.
How astronomical.
QUBT has a forward price-to-sales ratio. That's the stock price divided by expected sales per share over the next year, exceeding 2,400 times.
2,400.
Yes. Investors are paying $2,400 for every $1 of projected future sales. And on top of that, the company is still projected to post net losses in 2025.
Okay, so speculative doesn't even begin to cover it.
It carries a massive amount of risk. The narrative is powerful, yes, but the valuation is priced way beyond perfection. It's priced for, I don't know, miracles. Now, my focus here is on Oklo Inc. OKLOLO. This one surged 23.31% on Friday, hitting an all-time high for the third day in a row.
Oklo, what's the story there?
This stock is absolutely soaring because it sits right at the intersection of two of the hottest themes in the market right now: nuclear energy and artificial intelligence.
Ah, the AI energy demand narrative. That seems to be gaining incredible traction. It feels almost mythological in its power over stocks right now.
Well, it's powerful because the underlying demand is very real, and it's accelerating like crazy. The explosive growth of AI requires just enormous amounts of electricity to power these energy-guzzling data centers, and crucially, it needs to be clean, reliable, baseload power.
And Oklo fits that bill.
That's the bet. Oklo focuses on advanced nuclear technologies, things like small modular reactors, SMRs. They're seen as a potential scalable, zero-carbon solution to meet that AI power demand.
And did this rally get some institutional backing this week too, like a big bank weighing in?
It did, yes. Bank of America initiated coverage on Oklo with a buy rating, and they explicitly cited Oklo's potential, its superior positioning, to meet those rising energy needs from AI.
So Wall Street validation, that probably poured fuel on the fire.
Absolutely. It solidified the retail interest that was already there. I mean, this stock has just skyrocketed. It's up more than 500% in 2025 alone.
500%.
Yeah. And it's been helped along by favorable policy news, too, like that strategic U.S.-UK nuclear pact and a contract Oklo already has with the U.S. Air Force for microreactors. It's a very powerful secular growth story with government tailwinds.
Okay, and the third big gainer was a bit different. A more classic story. Bright House Financial, BHF. It jumped nearly 30%. This wasn't about some new tech or earnings, was it? It felt like pure M&A speculation.
Yeah, acquisition speculation, a clear sign of those animal spirits chasing a potential deal premium.
Especially when money is cheap. The market loves consolidation plays, right?
Yeah.
Particularly in financials.
Definitely. BHF, they're a huge provider of annuities and life insurance. They had already hired top investment banks, Goldman Sachs and Wells Fargo, earlier in the year to explore strategic options, including a potential sale of the whole company or maybe just a minority stake.
So the groundwork was already laid. Friday's explosive move suggests those rumors just resurfaced with maybe more credibility.
Or just more conviction from buyers. Prompted some feverish speculative buying, certainly. And the attraction is clear. Bright House has this massive investment portfolio valued at over $120 billion.
Oh.
That makes it a really attractive target for big alternative asset managers, private equity firms, who are sitting on piles of cash and are eager to deploy it into high-quality, long-duration assets like an insurance portfolio. Okay, so while some stocks were flying high on hope and hype, others were absolutely collapsing, usually under the weight of really bad news like regulatory disappointments or just deep financial problems. The market can be brutally efficient at punishing failure.
Yeah, let's look at the other side of the coin.
The sharpest drop on Friday came from Replimune Group, Inc., or EPL. The stock plummeted 39.4%, just cratered.
Replimune, that's a biotech, right? What happened?
Yeah, biotech. It followed a just devastating regulatory update about their lead cancer drug candidate, RP1.
Oof. Biotech investing is not for the faint of heart. Regulatory news is everything. So this wasn't just a minor setback.
No, this sounds like an existential crisis for the drug program. The company announced that after having a Type A meeting with the FDA, that's a formal meeting, you have to try and sort out problems after rejection. They basically said no clear path forward under accelerated approval has been determined for RP1 in treating advanced melanoma.
And accelerated approval was the key pathway they were hoping for.
It was. And this news came after the FDA had already issued a complete response letter back in July, which is basically a formal rejection of their initial application.
So they got rejected. They had the follow-up meeting to try and find a solution. And the FDA essentially said, nope, still no clear path.
That's how it reads. And the implication is incredibly dire because the company's own CEO had previously stated, very publicly, that without getting that accelerated approval, the entire RP1 program for advanced melanoma would not be viable.
Wow. So the CEO basically said, we need this or the program dies, and then they didn't get it.
Exactly. When the CEO telegraphs that kind of dependency and then the necessary outcome doesn't happen, investor confidence just evaporates instantly.
And I imagine the lawyers weren't far behind.
Nope. Predictably, Multiple securities law firms immediately announced they were investigating potential class action lawsuits,
Alleging what?
alleging that the company might have made false or misleading statements about the drug's trial prospects, about how certain its path to market was. It's the definition of high-stakes biotech risk blowing up.
Okay, and the other big decliner was a different kind of story, more of a slow burn. Wheeler Real Estate Investment Trust, WHLR, down 26%.
Yeah, WHLR reflects more of a protracted financial distress situation,
Sure.
a painful, ongoing restructuring. This wasn't a sudden shock like Replimune. This is the continuation of a multi-year struggle to deal with a crushing debt load.
So what triggered the big drop on Friday specifically?
It seems tied to the dilution factor. Wheeler is in the process of converting outstanding convertible preferred stock into new common shares. It's part of their effort to clean up the balance sheet.
Which helps the company's debt situation.
Right, but it dramatically increases the number of common shares floating around. That results in significant dilution for anyone holding the existing common stock.
Meaning each existing share represents a smaller piece of the company pie, puts downward pressure on the price.
Persistent downward pressure, yeah. And maybe the ultimate red flag here, looking at their history, the company has repeatedly executed reverse stock splits.
Where they combine shares just to boost the price per share?
Exactly. Often done simply to stay above the minimum price requirement to keep their listing on the NASDAQ exchange. It's usually seen as a pretty desperate measure and signals that the underlying financial problems are far from over. Makes it an extremely risky proposition for investors. Now, while the U.S. markets were basking in all this record-high glory and feeling those animal spirits, it's really important we keep a global perspective because we saw a pretty distinct divergence happening elsewhere, particularly in India.
Oh, really? What happened in India?
Indian equities actually snapped a 3-day winning streak on Friday. The main benchmark, the Sensex, it declined about 0.47%, and the Nifty 50 index fell 0.38%.
That seems counterintuitive. You'd think a big Fed rate cut in the U.S. would be globally positive, right? Easing financial conditions everywhere. Why did India pause or pull back?
Well, there seem to be two main drivers specific to India. First, just simple profit-taking. The Indian market had had a really strong run in the days leading up to Friday, so some investors likely just decided to lock in gains, take some money off the table.
Okay, makes sense. What was the second driver?
The second, and probably more influential one, was a fresh dose of geopolitical anxiety. And this one stemmed from a move by the U.S. administration.
Ah, okay. What specifically triggered that anxiety?
The U.S. government revoked a special sanctions waiver that India had been granted way back in 2018. This waiver was important because it protected India's operations at the strategic Chabahar port, which is located in Iran.
Chabahar port in Iran. Okay, so revoking that waiver.
It immediately raised concerns in India about their strategic and trade interests in that whole region. And it complicates their relationship with the U.S. on what's obviously a very sensitive foreign policy issue involving Iran.
So even subtle external policy shifts can inject uncertainty back into a market, even if the local fundamentals seem okay. But you mentioned there was a major anomaly within the Indian market, something that bucked the trend.
Yes, a spectacular counter-trend rally. It really proves that strong, company-specific news can sometimes completely overwhelm broader market or macro headwinds. We saw this in the Adani Group conglomerate.
Adani. Right, what happened there?
Pretty much all the publicly traded companies within the Adani conglomerate posted sharp gains on Friday, despite the overall market weakness. Adani Power, for instance, was up over 12%. Adani Enterprises rose more than 5.25%.
Wow, that's a huge divergence from the Sensex decline. A massive show of confidence. What sparked that specific buying in Adani?
It was a major positive legal development for them. India's main market regulator, SEBI, that's the Securities and Exchange Board of India, officially dismissed the serious allegations that had been leveled against the Adani Group by that U.S.-based short seller, Hindenburg Research.
Ah, the Hindenburg report. That caused a massive storm for Adani last year, didn't it?
Huge storm. So this ruling from SEBI, essentially clearing them, it signals a potential definitive end to this long, damaging period of intense regulatory scrutiny and uncertainty that's been hanging over the group.
So regulatory clarity arrives, and boom, pent-up investor confidence is unlocked.
Exactly. It acted as this powerful catalyst that just completely overrode the local market softness for the day. A profound lesson there.
Definitely. Regulatory clarity is gold. Okay, let's try and pull all this together now, synthesize this monumental week. All right, looking back at the week, looking at all the data points, the bull case, the argument for stocks going higher, It seems exceptionally well-defined right now, doesn't it?
It certainly feels that way. The path of least resistance, at least for equities, appears to be higher for now.
Driven by what? Let's recap the pillars.
Pillar 1, the highly accommodative Fed policy. Cheaper money. Pillar 2, surprisingly resilient corporate fundamentals, especially in tech, but now maybe broadening out to cyclicals too. And Pillar 3, those calming global trade tensions, specifically the U.S.-China détente.
And the narrative feels even stronger now because it's not just one story, right?
Exactly. We have this powerful synergy now. You've got the ongoing AI-driven secular growth story, which has been dominant for a while. But now that's being actively complemented by a cyclical tailwind generated by those lower borrowing costs.
So investors feel like they have two engines for growth pushing things forward, not just one.
That seemed to be the thinking, yeah.
And this isn't just a U.S.-only story either, is it? The Fed's dovish turn, that often leads to a weaker U.S. dollar that has global implications.
Huge global implications.
Yeah.
A softer dollar, combined with maybe greater clarity on U.S.-China trade, creates significant potential opportunities elsewhere, particularly in emerging markets.
Why emerging markets specifically?
Those economies often benefit immensely from a weaker dollar, as it makes their dollar-denominated debt cheaper to service and can boost commodity prices. Plus, less trade friction is almost always good news for export-oriented emerging economies. So the current setup looks quite positive for them too. #B, identified risks and vulnerabilities. Okay, so we've laid out the euphoria, the bull case. It's compelling, but we absolutely have to highlight the very real risks, the vulnerabilities that are now embedded, priced into this aggressively bullish market. The sheer speed and the enthusiasm of this rally, it inherently introduces fragility.
Right, nothing goes up in a straight line forever. What are the top risks you see that could quickly spoil this party, but maybe heading into the next quarter?
Okay, risk number 1, and maybe the biggest immediate one, is the potential Fed market disconnect.
Meaning the market expects more than the Fed is promising?
Precisely. The market, in its current state of, let's call it euphoria, seems to be pricing in an even more aggressive rate-cutting cycle, maybe thinking 3 or 4 cuts total this year than the Fed's own dot plot projections are indicating. Remember, the median dot suggested maybe 1 or 2 more cuts.
So the market has set the bar even higher than the Fed itself.
Impossibly higher, perhaps, which means the Fed has this massive hurdle to clear just to meet expectations. Even slightly less dovish talk from Powell or other officials, maybe just sticking to their own projections, could trigger significant disappointment and a sharp pullback.
Because if they don't cut as fast as the market wants, that cheap money fuel starts to look less certain, especially for those small caps and cyclicals that just took off.
Exactly. Risk number 2, inflation stickiness.
We can't forget about inflation.
No, the Fed pivoted towards prioritizing jobs, but inflation is still above their 2% target. What if it proves stickier than they expect? Maybe energy costs spike again, maybe wage growth picks back up unexpectedly?
What happens then?
Well, that could force the Fed to slow down its planned easing cycle. Or, worst case scenario, it could force them to reverse the dovish narrative altogether and signal they need to get back to focusing on price stability.
And if that happens?
A sharp, painful market correction becomes a very, very real possibility. The market hates hawkish surprises.
Okay. Risk number 3. You mentioned the structure earlier.
Yeah, the underlying structural issue. Bubble concerns. Particularly around that AI-driven rally in the Magnificent 7 megacaps.
Yeah.
Look, some of the characteristics we've seen, the parabolic price moves, the stretched valuations, the intense narrative-focused TAMs, they're consistent with bubbles we've seen in the past.
The valuations are stretched, making them vulnerable.
Extremely vulnerable. The market is highly sensitive to any piece of negative news that might challenge that dominant AI growth story, or maybe suggest new competitive threats are emerging in that space. If just one of those tech behemoths were to miss earnings expectations badly, the whole index could feel the pain because they carry so much weight.
Right. And the final risk?
I'd call it extreme market dependency. This whole bullish mood, this whole rally, it feels incredibly reliant on everything going just right, on achieving this near-perfect Goldilocks scenario continuing indefinitely.
Meaning what specifically?
Meaning the market needs both continued Fed rate cuts and continued constructive U.S.-China relations. If either one of those foundational pillars, monetary policy or geopolitics, were to seriously deteriorate unexpectedly.
Like if trade tensions flared up again or the Fed suddenly got spooked by inflation.
Exactly. That could cause a swift, severe repricing of risk across the board. A dramatic flight away from these high valuations we're seeing now. The market feels dependent on perfection.
Okay, so let's wrap this up. To summarize the key takeaways for you, the listener, from this really packed week, we saw those dual catalysts ignite the market. First, the Fed's 25 basis point cut, which crucially signaled they're now prioritizing jobs over fighting inflation to the last decimal point.
And second, that positive phone call between Trump and Xi, which seemed to ease trade worries and remove that specific uncertainty around the TikTok deal.
Then, maybe the single most important internal signal was the Russell 2000 small cap index finally breaking out to new highs. That hints at a potential, much-needed broadening of the rally into cyclicals.
But we also saw massive divergence in individual stocks. Huge winners like Oklo, the AI nuclear energy play, soaring over 500% this year, and catastrophic losers like Replimune collapsing on devastating regulatory news. Huge volatility beneath the surface.
So what should we be watching next week? Where does the focus shift now?
All eyes really are going to be on the new inflation data, specifically the Personal Consumption Expenditures Price Index, the PCE report.
Why PCE over the CPI we often hear about?
Because PCE is actually the Fed's preferred inflation gauge. It captures a broader basket of goods and services reflecting actual consumer spending patterns more closely than the CPI does. So investors will be scrutinizing that number very closely.
And listening closely to any Fed speakers.
Absolutely. Parsing every word from Fed officials for any hint, any sign of deviation from this dovish narrative that the market has now so fully embraced.
Okay, so the market is priced for near perfection. It needs continued rate cuts. It needs continued geopolitical calm. We know the Fed has explicitly told us they have a lower tolerance for job market weakness. Now they will cut rates to support employment, even if it means inflation stays a bit higher than 2% for a while.
That's the trade-off they seem willing to make.
So here's the provocative thought we want to leave you with. The ultimate risk-reward calculation investors are making right now. If the Fed has clearly signaled its lower tolerance for labor market pain, just how far above that 2% inflation target are investors actually willing to tolerate before those powerful animal spirits finally get spooked and turn back into fear?
That tension, that push and pull between wanting job security versus wanting price stability, that's the high wire act the market is walking right now. Where's the breaking point on inflation tolerance?
Something to ponder. Thank you for joining us for this deep dive into what was truly one of the most fascinating market weeks of 2025. We'll catch you on the next one.